Guys, welcome back to the MD Investor, the channel where we're talking about personal finance, taking responsibility for our personal finance by educating ourselves, teaching our children so we can break the cycle of generational poverty. If there's people out there you think could benefit, let them know. Let's get into it real quick. On YouTube, it's MD Investor. On Instagram, it's MD Investor1. So today's video, I want to talk about analyzing a dividend-paying company. Analyzing a dividend-paying company. We've done videos of different companies, and we've seen dividends and tracking our dividends and all this stuff. We've talked about dividend ETFs, which is basically a basket of stocks, where you get a whole portfolio already diversified, and it saves you the trouble of having to pick individual stocks. The downside is that there's an expense ratio, so it's going to cost you a little. But what if you want to do it yourself and pick your own company one at a time, like I've done? You're going to want to know, how do I do that? There's some obviously pros and cons to doing this. Obviously, the pros of you doing it yourself is one is going to take a little more effort as opposed to picking an ETF like Noble, the Dividend Aristocrats, where you just pick one stock or one ETF and it's already diversified. So it's going to take more time. You got to study, you got to research, but there's some upside, right? If you say, for example, I want a dividend yield for my portfolio to be at least 4.5 to 5%. You can get that by strategically and selectively picking stocks that have those high yields, right? Because with an ETF, you remember you're getting a basket, so you're going to have some low yielders in there, 1%, 2%. Then you have some little higher, 4%. But if you say, I want to take out the 1% and just give me the 3, 4, 5, 6%, you can do that. So those are some pluses and some minuses. Okay, so I thought the best thing to do is just go through an example, right? All right, so I made some notes here and stuff. So criteria for analyzing a dividend-paying company. First thing I probably want to mention is that have you heard of it before? I mean, most of these companies that other people talk about, AT&T, Johnson Johnson. You've heard of them, like you've heard of them. These companies are big and they have longevity. They've been around. You've heard of them. Have you heard of them? Have you heard of it? And obviously, you want to go on a site like Seeking Alpha to do a little more research. So you can get some common basic information, such as the dividend yield. Okay? So here, the dividend yield is about 3.1%. So let me mention the stock that we're going to research is PepsiCo, right? The beverage company and snack food company. We know they make Pepsi and Diet Pepsi, and they make also snacks, Frito-Lay brand of potato chips, and also oatmeal, Quaker oatmeal. So take a simple PEP. I have this in my portfolio. It's PepsiCo Incorporated. Dividend yield, we said, is about 3.12%. So when you're researching a dividend stock, so those are the first thing you want to look at, the dividend yield, right? If you have a criteria that I want nothing below 4%, you would ignore this. So dividend yield, and we said the dividend yield is basically the amount of dividend paid annually. In this case, $4.09 over the price, $131.05. That gives you the dividend yield. Okay, so we got a dividend yield. Next thing we can look at how big is this company. That gives you here the market cap, $182 billion company. So it's a big company. Companies could be small, right? Companies could be in the millions of dollars, which are pretty small. Be the category of like micro caps. They could be in the mega cap, which is like I think over like $10 billion, and then you could have a company in between. the mid caps, right? Between maybe I think a billion and like 10 billion. So this is a mega cap company, almost $200 billion, or $182 billion company. So we have the yield, 3.12%. We see what it is going for right now, $131. So we get information. You can look at the 52-week range. In the last 52 week, it has been as low as $101.42, and it has been as high as $147.20. So that kind of lets you know, right? If it's too high and it's trading at its high or the top of its range, not a great time to buy it. Why? Because you're getting less value, right? You have to pay more. It's just like anything else, right? You're not going to go buy a car if it's like at the top of its range, it's $50,000. When you wait for maybe the prices to drop or something, or that goes for everything else, clothes or whatever, or airline tickets. Perfect example. You're not going to buy it right before Christmas when the prices go up. You're going to buy your ticket early when you get a better deal. Same thing. So you get a 52-week range, and it kind of gives you an idea. Right now, we're kind of in the middle. Okay, so you want to get a good deal when you get this. So the price will let you know. Okay, am I going to get a good deal at its current price? That's why it's good to look at a 52-week yield. Sometimes opportunity strikes, right? For example, we just had this virus situation. Prices drop. So you look at a lot of these companies are at 52-week lows, buying opportunity. So, sometimes the market presents itself. Here, the next thing you might want to look at is the PE ratio. The PE ratio stands for price to earnings ratio. So basically, it's a ratio. You take the price, $131, and you divide it by the earnings per share. You'll go here. Actually, they have it here, $5.32. So you take $131, divide by 5, and you'll get about 24, right? The price to earnings ratio. Sometimes they use the term price to earnings multiple. And this gives you an idea of kind of how expensive the company is. Have you ever thought about two companies, right? You'll have a company that's trading for $131, like Pepsi. And then you'll have another company that's trading for $15. Wildly different price points. $135 or $131 for Pepsi, and maybe $10, $11 for another stock. Which one is more expensive? Well, it's kind of comparing apples to orange, right? $131 and $10. Well, this $131 is more expensive, or it's a higher price, but is it really more expensive? The price to earnings ratio, the PE ratio, or the PE multiple, is a way of comparing, making them equivalent, comparing apples to apples. PE ratio in the range of, say, 10 to 18, 19, 20, around there. It's considered like fairly valued. You're getting not a super great deal, but you're not getting robbed either. It's fairly valued, essentially, right? So it's priced fairly, right? It'd be the equivalent of buying a Mercedes-Benz for $80,000. Okay, price fairly. Now that's how you can compare two different stocks with different prices and see which one's the better deal. Because the ratio makes them equivalent. Okay, so we say about anywhere from 10 to 20, 10 to 19 is like a fairly valued. You get a PE ratio below 10, and that's considered a low PE ratio, a quote unquote good deal. Ratios above 20 and so on, like Pepsi here at $24, is considered a little expensive. But because it's a ratio, you have to be careful, right? You have a denominator, you have a numerator. The numerator is the price, and the denominator is the earnings per share. So the earnings per share, which is the denominator, if the earnings drop or decrease and the price stay the same, the ratio will go up. The PE ratio will go up, right? Because essentially you're paying more for less. You're paying more money for less earnings. Okay, so the ratio of 24, P ratio of 24, essentially means your people are willing to pay $24. You're paying $24 for every dollar of earnings the company makes. That's essentially what it means. PE ratio of 24 is basically 24 to 1, meaning you're paying $24 for every dollar in earnings the company makes, right? So the PE ratio is 50. That means you pay $50 for every $1 in earnings the company makes. The more expensive, some more expensive share, more expensive price is valued much higher. Likewise, if the PE ratio is 5, I mean you're only paying $5 for every $1 the company earns in earnings. Like, just remember, again, it's a ratio. So if the denominator, which is the earnings, drop, the ratio goes up. Okay, the ratio can also go up if the price goes up and the earnings stay the same. That could also cause the PE ratio to goes up. Okay. Likewise, the PE ratio can fall if the earnings go up and the price stay the same, and the PE ratio can also go down if the price drops and the earnings stay the same. So you got to be careful, okay? You got to be careful with that. So something might appear cheap, or the PE ratio is very low. I'll go pick some of that up. It's a great value, but the PE ratio could be low because the earnings, or correction, the PE ratio could be low because the price has went down. Now you got to ask yourself, why is the price going down? Price could be going down because there's something fundamentally wrong with the company, right? Perfect example was again with the coronavirus situation where Carnival Cruise Lines and all the travel stock, airline, travel, all those companies, their prices were going down. Their earnings pretty much stayed the same because it didn't really move yet, but the prices were just plummeted, and the PE ratio was essentially going down. It made it look appear like, it's a cheap company, let's go get them. But there was something fundamentally wrong, right? Why is the price going down? Because people are not flying anymore, people are not traveling anymore. So just something you want to keep in mind. So the PE ratio is a way to evaluate apples to oranges, right? So you have a company like Apple that is, let's take a look at Apple. Let's take a look at Apple, see what the PE ratio is. Apple is trading for $358. PE ratio is 28. Right? So you paid $28 for every dollar in earnings. So even though it's more than twice the price of Pepsi at $131, it's only a little more expensive, if you'll use that term, because the PE ratio of Apple is 28. It's 28, and the PE ratio of Pepsi is 24. So even though you might say, "Oh, it's twice as expensive," yeah, maybe on a per share basis, right, 130 to 358, but the PE ratio is only a little more expensive, and that's how you can compare apples to apples. Okay, let's get back to our example that we were using. Because I always wondered about that myself. How do I compare two companies when one company is so the price is so high, and if the PE ratio is what you use. Okay, let's get back to our analysis. So we have went through the PE ratio. Let's go over the dividend history. So obviously, when you're evaluating a dividend company, obviously one of the things you want to look at is dividend, right? Because what's the bottom line? The bottom line is you want to pick a stable, solid company with competitive advantage, right? They have some type of advantage, whether it's brand recognition, whether it's customer loyalty, whether it's product, whether it's services. They have some competitive advantage where people love to go to them. They trust them. Okay, good times, bad times, they have weathered the storm. Because basically, you want to make sure that when it's time for you to retire, stop working, or start collecting the dividend, that they're stable, right? They're not going to be anything that's going to, no competitor that's going to come along and disrupt them. And say, well, I could build a better burger than McDonald's. And you have 2,000 shares of McDonald's. I didn't see this coming, right? Right? Or I can do a better job than Johnson and Johnson. You want to make sure that I don't see that coming. Johnson and Johnson has been doing this for 50 years, and if another competitor comes along, they're big enough that they'll just buy them and make them part of the family. So let's look at the dividend. Okay. So we said the dividend yield for Pepsi again is at 3.12%. You get that by the annual payout, right? Which is the quarterly payout is $1.02, and it's 4 times a year. Gives you $4.09 annual payout divided by the price. That gives you a 3.12% dividend yield. But we know that there's something called inflation, right? And this $1.02, it might be okay today, but in years to come, that $1.02 won't be able to buy the same thing that it bought years ago. So we're going to need dividend growth. But before we get to dividend growth, let's look at the payout ratio. Very important metric. The payout ratio is basically the company earns earnings, right? That's the profit they make. And we don't want them to pay out 100% of the earnings in dividends. Why? Because there'd be nothing left over. In case what? The cost of goods and services go up. There is a competition. Raw material goes up. Or anything, right? The world is unpredictable, as we have found out in the last couple of years, right? You don't know what viruses lays around, what competitor tries to come along and disrupt you. There's going to be maybe the people may strike. You don't know what may happen, right? The debt that you owe, the interest may go up. You don't know what may happen, so you need to be able to have money just in case. So you do not want to pay out all your money in dividends. We love dividends and everything, but we don't want the company giving out all their money in dividends. We want them to give only a portion. So this company, Pepsi, is giving out 76.81% of its earnings in dividends. Okay, so they're giving out $4.09 in dividend, which is about 76% of the earning. Let's specifically go to earnings and see if we can kind of let's see what the earnings are. They have here earnings per share, and the actual earnings per share is $1.07. I'm not sure if this must be the quarterly, because if they're giving out $4.09 per year, this can't be the yearly. This can't be the yearly. Let's look at earnings estimate. Let's see if that helps us. Okay, this helps us. So we said they're giving out about $4.09 per year in dividend, and here they're saying that they're making about $5.32 in dividends. I mean, $5.32 in earnings, right? Earnings per share $5.32, and they're giving out $4.09. So they're keeping a dollar and change per share for the company, which is exactly what you want. You don't want to give everything out. So a dividend payout ratio of about 45 to 60% is good. 75% is a little high, but there's still enough for the company to keep um, to research and grow the company and so on. The other important thing you want to look at is the growth rate, the dividend growth rate. They have the 5-year dividend growth rate. They say here about 8.41%, which is what you want to see. Let's look at that in. They break it down here in 1 year. The 1 year dividend growth rate about 5.7%. 3-year dividend growth rate 8.61%. 5-year dividend growth rate 8.41%. And down here they have it in graph form. This is what you want to see, guys. So to go back to 1990, and the amount of dividend they were paying was about 19 cents. I think this was this is quarterly. In 1991, they paid 23 cents quarterly, 25 and a half cents, 30 cents, 35 cents, 39 cents. Okay, there's a split here, 44 cents, 49 cents. Look at how the dividend is going up year after year after year after year. This is what you want to see. Dividend growth. That's why we do the research, okay? If we were researching a company, right? Let's go back, for example, 2008, right? This is the year, 2007, 2009. Always a good year to look at because that's the year of the Great Recession, right? A lot of companies cut their dividends, suspended it, decreased it. In 2007, 2008, $1.42, $1.65, $1.77. Still raised it during that critical time. So that gives you confidence then when another critical time comes along, another recession, depression, slowdown, whatever you call it, like we're in now, they have history that they continue to chug along, and I give you confidence. So dividend history, you want to look at that. Years of dividend growth, almost 50 years. They're almost a dividend king. All right, remember, dividend aristocrats have raised their dividends year over year for 25 years. Dividend kings have raised it year over year for 50 years. They're almost a dividend king. So some of the things, guys, you want to look at. The other thing, guys, you want to look at when you're researching your company is you definitely want to look at the debt. So I basically went on to the PepsiCo brand. I mean their website. The 10K. These are some of their brands. We know Lay's potato chips, Brisk, I guess iced tea, Pepsi. I guess something called Bubbly that may be in a brand in another country. Tostitos, Mountain Dew, Quaker oatmeal in the morning time. But let's go and look at you want to look at a little debt. So these are some of the brands, okay? And again, do you recognize anything that lets you know, like, okay, this company is kind of out there in our consciousness. It's been around, and they're, bringing value to shareholders. Let's go look at something that's important, guys. You want to look at is debt, okay? Let's see if I can find that here. And the reason why I say debt is just like in our own life, um, you don't want to have too much debt, and the reason being is the interest you have to pay on that debt. I say that because whether the company is having a good financial year or a bad financial year, if you have debt, that debt has to be paid. That interest is going to be paid regardless. So here is a nice chart that's giving you a nice little summary. and it kind of disappeared on me. So let's get it back. I think it was on page 37. So just like you, companies are no different. They don't want to take on too much debt because of the interest that they pay. Now look here at before we get to the debt, look at the net revenue. 2015, right? 63. These are in billion. 63 billion. Right, about 62 billion, 63 billion, 64 billion, 67 billion. So the revenue, which is basically the sales that the company is making, have been pretty steady from 2015 to 2017. Went up a little, and it went up a little more in 2019. So you want to see that. You want to see sales going up. You want to see revenue going up. Operating profit, which is basically probably after expenses, also you want to see that going up too, right? So again, from 8 billion, 9 billion, 10 billion, so pretty steady. Let's look at debt, right? The long-term debt obligation down here. It's about 29 billion, 28 billion, but it remain steady. So you see your income or your net income, your net revenue is 67 billion, but your debt is only 29 billion. So your revenue is more than twice your debt, which is good. Another thing I was looking and studying, they said that you want your debt to asset ratio of about no more than 0.4, or say 40%, meaning you want your debt to be no more than 40% of your total assets. Total assets that Pepsi has is about $78 billion, meaning all their real estate, all their equipment, their intellectual property, everything they have is about 78 billion, and the debt is less than half, right? So yeah, it's less than half. So I didn't get the exact percentage, but it's probably in the order of about maybe probably about maybe about 40% or so. And just like in your own life, you don't want your debt so high that the interest alone is just like sucking all your cash flow. Okay. So guys, so just a quick highlight about some of the things we look at when we're evaluating a dividend company, right? So quickly review with it. Have I heard of this company before? The dividend yield, right? Because you may have different criteria. You may say, I want nothing less than 5%. So then you would go look for that. How big the company, the market cap. Say the bigger the company, the more stable it is. The less that another company will be able to disrupt it. If a competition or competitor comes along, they buy them. They what they call merger and acquisition. They just consume them because they're so big. So if a company is too small, that company can be taken over, right? So even how great a company is, if it's only 1 billion, a company may come along and take it over. For example, a beverage company comes along, whether Snapple or whatever, and they're doing good. Pepsi or somebody who just come in, they will acquire them. So you want to make sure your company is big enough. The 50 billion to $100 billion range is probably pretty good. Lower, 2-3 billion in a small company may be able to be taken over. The dividend payout ratio, we talked about that. We said maybe anywhere from 45 to 60% ratio of earnings being paid out as dividend is pretty good. We don't want anything to be paid out too high. But let me add, certain sectors that like the utility sector is notorious for paying having a very high dividend payout. So utilities such as Con Ed, Dominion Energy, all those companies, they pay out usually 80-85%, and that's standard across that sector. But you shouldn't see that. Also, REITs pay out very high because they're required by law to pay out a very large percentage back to shareholders. But if you're buying a consumer discretionary company, a pharmaceutical, you don't want to see 95% of the earnings being paid out. We look at the 52-week price range, the 52-week range to see where the current price fits. Are we getting a good deal? Is it at the 52-week low? Is it at the 52-week high? We don't want to buy too high because we're not getting great value, right? And the dividend history, what's the track record? Have they had a dividend cut? And have they been growing the dividend year over year? And at what rate? Is it at only 2%? Because that's only barely going to keep up with inflation, or are they raising it at a nice clip, 7%, 8%? So, guys, quick video again, studying and learning, trying to take responsibility to analyze stocks for ourselves in case you want to go that way. And you look through one company at a time and begin to build your portfolio so the cash can begin to roll in and you can begin to get passive income and begin to have that snowball effect. So the people out there, guys, you think could benefit from this, just remember to let them know about the MD Investor. We're doing it one video at a time. We don't have an MBA, we don't have a CPA, but we do have motivation, we do have willpower, and we do have a dream and a desire to be financially independent. So until the next video, guys, we're going to say continue to command your money to grow, and I will see you on the next one.